especially lately, there's been a lot of really good reviews that have come in, and so we're so thankful for that. We have a lot of different seminars that are coming up, and so I just want to mention these as we get started. First of all, yeah, so upcoming dentist block at noon. It'll be those New Year's resolutions. Basically what you need to do going into the new year so that you can be compliant with some of the new laws that are coming up that are going to take effect in 2025. So don't miss that. And if you have to miss it, you can always look at it up on, just go to aoausa.com and hit the YouTube icon up at the top, and it'll take you to our YouTube channel there. Excuse me. Anyway, so, and then next week, I plan on doing a Zoom rental criteria workshop. And this is because of new law that's going to be taking effect, where if you're collecting a tenant screening fee, you need to give them a rental criteria, like a printed out version of your rental criteria, to be able to charge them. And anyway, so we've covered that before, but we're going to cover it again. There's some things that are new there. January 7th, we'll have Michael Brennan also do a legislative update. And, that one you'll want to see. The 14th is going to be basically a tax update, and just the new things that you can look for. So that along with a second one, which is going to be the new resident manager wages, hours, laws that all relate to that. So even just those things coming up, all on live stream. So if you hit the subscribe and then toggle the notifications on, at least you'll get notified when we go live with something. And then we have a lot of in-person stuff happening too. January 21st, Dennis Block will give a legislative update at Hotel Angelino on the west side. And there'll be a doubleheader with as well. And then on the 22nd, very next day, we're in Buena Park doing the same thing. And on the 28th, we'll be in Long Beach. And all of these are just legislative updates, comprehensive legislative updates, and you'll have the ability to ask questions. And then in February 19th, we have the Bay Area Landlording Power Conference, and that will be in Santa Clara. And then on the 26th in San Diego, we have screening tenants, setting criteria, move-in process, along with a lot of other stuff that Franco Simone's going to do, who's an attorney local to San Diego. And all of these are doubleheader events. And so I just wanted to let you be aware of those things. Some of them are not even listed yet. There's a couple of those that are not listed, and we'll get those up hopefully within the next week or so. But yeah, just go to the AOA website. There's a seminars tab, and you'll find all about those and other things. And right now you may be watching on aoausa.com, and you can always watch from there. And if you have a question today, you can just put that in the chat, and they will get that question to me. So there's the little blue help button, so you can utilize that to ask a question. And then if you're on Facebook, YouTube, you know what to do. Just put it in the chat and we'll be able to respond to that. And really just want to say thank you to Cay Properties today for sponsoring this event. They're a national DST firm. They're licensed in all 50 states, or investing company that does those. Anyway, they collectively have over 115 years of experience, real estate experience. They've participated in a staggering 30 billion of DST 1031 investments, and they have access to all the different sponsor companies, and they go through those and they find the best ones. And anyway, we'll be talking about that today. But our speaker today is the president of Cay Properties and Investments. He has been instrumental in the firm's participation in over 15 billion worth of real estate offerings. A specialist in the 1031 and real estate market, he advises clients nationwide on multifamily and commercial real estate, DST, tenant in common, and fractional triple net. Yeah. And anyway, so he does that. He's recognized as an industry leader. He is regularly featured in publications such as BizNow, The Commercial Observer, Yahoo Finance. He's a UCLA grad and a former four-time academic All-American water polo athlete. So excellent in so many different ways. And he even went to the Olympic Games in London in 2012. And yeah, so it's great to have you with us today, Chay Lapin.
Yeah, thank you, Jeff. We always appreciate the opportunity to be with your team and all your members. I think it's been well over a decade since we've been participating in different conferences and webinars and things like that. So we really enjoy being in front of everybody. Should I take over here now?
Yes, please. Yeah,
All
so you
right.
can share your screen and we can get going.
Hopefully, let's see here, technology, full screen. And some of you guys will notice that I'm on my partner's Zoom here because my computer decided not to agree with me this morning. But before I dive into today's presentation, again, thank you everybody who's listening or watching. Just a quick risks and disclosures. I always like to, just start out and let everybody know there's always risks, in all investments, particularly also in real estate investments of all different structures, whether it's DSTs, you're owning something on your own, different funds, whatever it might be. So we highly recommend always engaging your, CPA and your legal counsel as you're diving in, because everybody's situation is different, whether it's a tax situation or a, entity or legal situation. So I'm sure the AOA has really good referrals from that standpoint, if you don't already have somebody in that category. The other thing to note, DSTs are, from a regulatory standpoint, available to only accredited investors or accredited entities. From a high level, that means you have a net worth of $1 million or more exclusive of your primary residence. So you can include, it's not $1 million liquid, it's your net worth. So you can include different investment properties and, other investments you have. Entities can qualify, like if you're in a family trust or an LLC, those can qualify if all the underlying owners of that entity are accredited investors or that entity has gross assets of over $5 million. There are some, if you don't qualify for either of those, there are some income qualifications. I would just encourage you to reach out to our firm and we could kind of do a light consulting to see. With all that said, now we're going to dive into today's presentation, just on, a little bit about who we are and what we specialize in. And, always feel free to reach out. I'm going to kind of, out of respect of people's time, kind of go through from a high level. But as I mentioned, everybody has a slightly different situation. So, happy to talk offline, but myself and or any of the members on our team. So, as Jeff mentioned, we are, a nationwide company. We work in all 50 states here in the United States. We have advisors that, are focused within different regions. I think that's unique, when we kind of step back and we look at the different cycles that we've been in the last 2 decades, whether it was, the 2008 cycle, the COVID cycle, or the interest rate environment and inflationary that we're experiencing right now, or geopolitics, whatever it might be. Different asset classes react differently in different cycles. Even an asset class, here on the West Coast versus the East Coast or the Midwest, and so we really, because of that involvement over, through, K Properties and our team over the last 2 decades of being exposed to, at this point, close to $40 billion of real estate that's been invested across the United States. We're getting reports on these deals on a quarterly or monthly basis. And obviously nothing is guaranteed, but we can see trends, from time to time and see how different areas are reacting to different, economic environments. And I think it's a great thing to kind of engage us and talk with us about, just like as you guys being focused here in the Southern California, you have your pulse on it. We have a pulse kind of throughout the United States. So the 1031 exchange, just to, go over this, I'm sure most people are familiar with it, but just in case, I'm going to go over some high level on it. Ultimately, the 1031 exchange is a great tool over the last 100 years that it's in of existence. And it allows investors to defer that growth going forward and potentially, depending on the state laws in the future, as you pass, your heirs or estate get a step up in basis, depending on, what the estate laws are at that point in time. So people, as you invest, and I'm just throwing out random examples, you might invest in a property or bought a property 10, 15, 20, 30 years ago for, a couple $100,000, and now it's worth $3 million, or $1 million, it's worth $5 million, whatever it might be. You have a substantial gain. Your tax consequence isn't just the capital gains, so as we've seen with different administrations, different, capital gains going up and down at the federal level and at the state level. Here in California, obviously, we're in a higher state tax compared to a lot of the other states in the country. And so when you combine state and federal, that could be a significant chunk, depending on how much, gain you have in your asset, how much appreciation you've created over the years. But one thing that people look over oftentimes is depreciation recapture. So it's definitely something to ask your CPA. 25% of the recapture tax if you don't 1031 exchange and cover, your replacement value. So I've seen in some cases where that's, equally or close to the capital gains tax. So that's what, a lot of times I talk to clients and they think they're at a 20% tax bracket or 15% on the sale, and then they didn't include all these other, and all of a sudden they're at, they have Obamacare tax, the depreciation recapture, and all of a sudden you're at, 30-40% tax. So definitely talk with your CPA, because that can make judgment calls on, depending on where you're at in your life stage, do you take some chips off the table? You don't have to do 100% 1031 exchange. You've created a lot of wealth potentially in your properties, and maybe it's time to, take some and pay whatever that pro rata tax is. And, obviously check what that pro rata tax is and the consequence. But if you're comfortable with whatever that is, that's a way. If you sell, a couple $1 million building, take, 500 grand, put it in a nest egg or whatever, you might think you need over the next 10 years, or, paying for kids' college, grandkids, having fun, going on vacation, whatever. But, that's the neat thing about what we're going to dive into today with the DSTs, is this vehicle allows you to have a potential full tax deferral. It also allows you to have a partial tax deferral and gives you that flexibility of what I just explained. And so, with the 1031, we're going to assume right now that people are trying to have a full tax deferral. They're not taking any, proceeds off the table. And so to do a 1031, you need to set up a qualified intermediary or an accommodator. They're the people that will receive that money at the close of your asset. The second thing is you got to reinvest 100% of your net sales proceeds. So whatever money you receive, if you receive $2 million, you need to reinvest that $2 million. Number three, purchase equal or greater value. So if you sold for $3 million, if you want a full tax deferral, that net sales price is $3 million. We got to buy at least $3 million of property. Now, some people ask, they go, well, I sold my $3 million property and I have a $1 million loan. So in my intermediary account or at my closing, I only received $2 million. How am I going to replace $3 million? Well, you can replace that by two ways. Get another loan for another $1 million to bring you back to $3 million of purchase value, or add in out of your own cash $1 million to get to that $3 million. Most people don't want to just add in $3 million. We've seen it be done. I mean, I'm sorry, add in $1 million. We've seen that be done, but we do have DSTs that have a debt component on them. So we can absorb the debt, which we'll dive into later, on the DST to get you to that $3 million mark and have the full tax deferral. But that it is kind of interesting. You'll see me kind of go on sidetracks here as thoughts come up. But, if you have a $3 million exchange, and you're trying to have a full tax deferral and you're going out and trying to buy a property on your own, that means, how many properties out there that are going to fit your exact style box of what you're looking for is going to be exactly at $3 million. It's probably going to be rare. Not that it doesn't exist, but it's going to be rare. You're going to have some properties that you like at $2.5 million. Well, that's not $3 million. You're going to see some properties at 3.5 or 3.3 million. Well, now I'm having to add in more money to my exchange or get more debt to get to that, property I like. Where the DSTs, you can kind of get, in most cases, always an exception to the rule, but most cases exactly to the dollar that you need in a property that, fits your style box. And/or we have some investors, maybe DSTs are not your primary goal. Maybe you're not ready to be 100% passive yet. In your life, you still want to have control. You still, you have energy to go out and manage and create value, etc. We work with a lot of investors that are still in that stage. So DSTs are not just for passive investors or mailbox money investors. What the active managing people will utilize us for, and these, these can range from anywhere from 3 million to 100 plus million. We're talking to someone right now with a $400 million exchange coming up, where they will utilize us to cover or a backup. So in that scenario with a $3 million, if you go find the perfect property at $2.5 million, we can cover the remainder 500 grand in DSTs. So then the aggregate value of the property you bought, that's gonna, you're gonna actively manage in conjunction with the DST, you now have met the $3 million replacement value. So I just bring that up as an example because, again, there's a lot of different investor profiles that DSTs can potentially benefit. It's not just for the person who wants to be 100% passive. The last two rules are just, when you go into a 1031 and once you close and that money's sitting in that intermediary account, you really only have 45 days to find the properties that you're going to do and then identify. So all you guys are, real estate professionals. You've owned real estate for a period of time. You're obviously, exposed to strategies through the AOA, but we know that it's hard to find and do all of your due diligence in 45 days and go under contract on that property and get back your environmental report, get back your engineering report, get back, appraisals, all that stuff. That sometimes it comes in quick, sometimes it takes 3 to 4 weeks to get those reports back. And then you get the reports back and now you're, negotiating with the seller of, oh, we found these repairs, or it's not earthquake, retrofit, whatever it is. And then you're trying to retrade your price or negotiate. All of a sudden you're past your 45th day. If you identified that property with no backup IDs, you're kind of stuck with that deal that had a skeleton in the closet. So we encourage, if you're, again, finding a property on your own, maybe use DSTs as a backup strategy. It's also a negotiation tool because when you go to that seller, you go, look, you're not my only option. I have these other properties identified. If you don't want to give me a credit, I'm just going to move to over here. And so it gives you some power, again, for those people that are trying to focus on their own property. But for the people that want DSTs, the nice thing is these are ready to go. The sponsors, the ones who manage these assets, have gone through that process of acquiring the property. So, doing all those third-party reports, estoppels, tenant interviews, whatever it might be that takes place, all the legal negotiations. And you guys have access to all those documents day one. So, on your first day of your 45 days, or even before you're in your 45 days, you're kind of diving into that. It's, it's pre-packaged, ready to review, so that you don't get in that stressful 45-day window. So again, this PowerPoint's available to anyone. I mean, in fact, I think it's just on our website. You can go, download it if you, want to reference what I'm talking about.
Hey, Chay, real quick, are you actually going through the presentation? I see
You're
like
not moving?
I see the start of it, but I don't.
Oh, I am sorry. It's moving on my end. Let me check something really
Yeah,
fast.
just as far as which one is actually being shared, like which tab or window or whatever, maybe.
Yeah, hold on. It might have
Excuse
paused.
me, I sorry to interrupt you there.
That is a great hopefully my talking trying to resume the so as I work through this, I'll just continue to talk, guys, because for some reason the Zoom is pausing my screen share. But all that was on the shares is kind of visuals of what I'm speaking about. So I do apologize to everybody. I'm going to try to re-share my screen here really fast, see if this works. But as we go through and I'm working, is that working? Okay. So just a real quick recap. I was just showing a visualization of kind of that flow of the time frame. And like I said, you can go on our website and dive into that. So getting back on track here, thank you, Jeff, for bringing that up. What does like-kind property mean? So just real quickly, we have run into investors, over from time to time that maybe read the like-kind as a literal. So if you sold an apartment building, you have to buy an apartment building, or you sold an industrial, you have to buy an industrial. Like-kind actually refers to the nature or character of a property, and that it must be held for productive use in trade or business or for investment. So you can sell your multifamily property or residential property and exchange into an industrial property, or diversify amongst many different asset classes. That's another thing in today's world. The investing world, if you look at the last 100 years, when you're just generally, and I'm not giving investment advice on that side, but generally when you go to that type of wealth manager that's managing your other finances, they're usually encouraging or creating some sort of diversified portfolio for you. They're not just saying, hey, so you have $1 million in cash, let's put that all in Google stock, or let's put that all in crypto. Whatever it is, they're generally diversifying you across a stock portfolio, a bond portfolio, different vehicles like that. And real estate's the one asset class where historically people have over allocated in, and not for good or bad, but that's just the reality. And now we're in a market in the last decade, as technology advances, things move fast, news travels fast. And so you see effects in the economy happen really fast. And if you have all your eggs or laws being passed really fast, or at least hovering over us all and creating difficulty, so diversification in the real estate sector, in my opinion, and again, each individual investor might already be diversified, but the DST provides an investor the potential to kind of spread their investments across 5 different buildings, 10 different buildings. We've had some ultra diversify across 40, kind of creating a middle, like a mutual fund of real estate. And so the DST is unique in that aspect. Also, some people want to diversify across other geographic locations, have assets here in California and then also elsewhere, but they might not understand the markets fully, or how are you going to manage something from a distance, et cetera. So that can kind of play into the DST land. So the DST that I'm referring to stands for Delaware Statutory Trust. It's ultimately an entity that's used to hold title to real estate. It's very, in some respects, similar to like an LLC or a family trust. And, so if a lot of you guys, if we went and, looked up your personal residence, I'm assuming that would be in some sort of family trust. So the asset isn't owned by you, it's owned by the family trust, and then you are the beneficial owner of that family trust, which means you know, own anything underlying that trust. So the DST is the same thing. If you went and pulled a title report on whatever the property was, you would see that the entities of the DST own that. And then there's beneficial owners of that, whether you invest $1 million in there and you're a 10% owner or whatever it is, you get 10% of, you know, everything that potentially goes on inside there. The other thing that is the most unique with the DST and the reason why we utilize it is because it can be used for 1031 exchanges. Typical LLCs and partnerships, you cannot 1031 exchange into. There's very little flexibility there. And if you do that, it's a very unique situation. But DSTs are unique because the IRS has blessed them as a 1031 exchange compatible vehicle under IRC Revenue Ruling 2004-86. So that is nice in respect of, you know, having the actual revenue ruling rather than like a guideline or something like that. And you know, in 2004 is when they made this revenue ruling, and then the industry just skyrocketed. Prior to 2004, people would use different structures, whether it was TICs or some were even DSTs, but they were all under private letter rulings. DSTs can close if they're available, and you pick a DST that's available in 3 to 5 business days. So that means, you know, if you're pre-planning your exchange while you're under contract of selling your property, you can, you know, start to, if you found the DST that you're comfortable with, start to do the paperwork, and the day you close, the next day the closing process is, and in 3 to 5 days, you start your income again. That potential income. And that could be a significant amount, right? The normal real estate transaction, usually because of doing an LOI, negotiating a PSA, ordering all the third-party reports, doing all your retrades, lining up closing. If you have a debt component, the lenders, you know, causing delays, that could be anywhere from 30 to 60 to 90 days. Sometimes the seller that's selling to you has a clause for their own 1031 exchange. So all of a sudden you just missed out on 1, 2, 3 months of income. And if you have a large exchange, if you have a $5-10 million exchange, $3 million, that's a lot of money potentially that you're not getting a return on. The reason why they can close so quickly is, as I mentioned before, these are prepackaged. All of the deal owns it. You can close today, and Chay can close a week later. We don't have to wait for all the investors to be together in order to start income. Different types of real estate that we focus in and different sponsors focus in. Multifamily, you know, long-term net lease properties, which I'll address in a little bit. Probably a lot of people are familiar. Medical, self-storage, industrial properties, multi-tenant retail. So there's really a variety because every investor has a different, you know, set of goals, different vision, different experiences with different asset classes. So we try to, on our platform, have a variety, a diversified approach for you to explore. And then we have some that are debt-free and some that are leveraged. So it's talking about, you know, the leverage and debt-free, like I said earlier in the front end of this conversation, if you have debt when you sell your property, we need to replace that debt to meet the purchase price, or you need to add in cash. A lot of people, again, they just, you know, replace it with new debt. If you're debt-free, you don't have to take on debt. You can stay debt-free, you know, not have, you know, the risk potential that debt brings to the table. You know, that always brings an extra layer, although a lot of our deals are, you know, lower loan to value with higher debt coverage ratios, but there's still a level of risk there. But if you're debt-free and you've owned your building for a very extensive amount of time, you might be fully depleted. So, you know, always reach out to your CPA and understand your depreciation table. Is it worth getting new property? So if you are debt-free with $3 million and you go buy DSTs that are at just for simple math, 50% loan to value, you just bought $6 million worth of property, $3 more million of fresh basis for depreciation. So some investors that are, still willing to take a little risk, they're still tax conscious and doing tax strategies. That's something that you can consider blending into your debt-free situation. Our investors that do that, they don't go all in on that strategy. Don't let the tax tail wag the dog. But you can kind of blend that into the picture. I'm going to go through these quickly, but there's, like I said, multifamily related from single family home communities to multifamily. We do a lot of these are like triple net properties. This is a Frito-Lay distribution center. FedEx distribution. A lot of people like the logistics, people who believe kind of in that internet world, the ever-changing world. Medical tenants, another Class A multifamily, Amazon distribution centers. We've done a bunch of those over the years. And that to address the triple nets really fast. So, as you're looking to maybe have less management responsibilities, if that's where you're at, right? Or maybe for a piece of your exchange, like we talked about earlier, the net lease are, a lot of properties that people look at for that passive or mailbox money, and then DSTs. Now, net leases are not 100% passive. There's still a level of management there and responsibility there, where you can get the net lease properties because some people just like the corporate lease, right? The long-term 5, 7, 10, 15, 20-year lease on there. And they feel, oh, I believe in that tenant. As long as they don't go bankrupt, I'm going to receive that rent. And so the DSTs have that. But I see a lot of people think that triple nets or net lease properties are 100% passive. There's still, depending on the lease, on another side of my business, in another company that we have as a sister company, we manage, hundreds and hundreds and hundreds of millions of dollars of net lease property. So, upstairs in this office, I have a whole asset management team, accountants and attorneys that are managing that portfolio. And on a daily, weekly, monthly basis, there is always something to do on those net leases. Now, they are less management intensive than a multifamily deal, right? You're not dealing with 30 tenants, but dealing with the Fortune 500 company, there's always stuff going on. And dependent upon the lease structure, it might be a net lease where they're responsible for property taxes, insurance, and repairs. So maybe the lease reads that, well, the landlord's going to take care of it and they're going to invoice us. So those, okay, when a repair happens, your facilities manager's calling you, you're organizing, and you're paying the property tax bill. So you better save a lot of money in your bank account, because on those triple nets, you might have a $40,000-$50,000 property tax bill. Even though you're going to get reimbursed, you got to make sure you have that when you pay it. So really understand that net lease before you buy one of those and dive in. And then the other thing is over concentration. So net leases are great until they're not. Like I said, we manage hundreds and hundreds of millions of dollars. I'm a personal investor in a lot of net lease properties. So I'm not saying they're bad, but to have an over concentration of 2, 3, 4, 5, $6 million, when that lease comes due, what if they don't re-sign? You are stuck with a building that you might have never experienced having to re-tenant. And re-tenanting a commercial asset is about 1,000 times harder than a multifamily deal. It costs a lot of money. You have to potentially have hundreds of thousands of dollars for leasing commissions. You have to have a lot of TI money potentially. You have to get out there. It could take 18 months to find a tenant. In these ever-changing world, the world is moving fast. As I mentioned earlier today, or earlier in this webinar, this corporation could be great today, and it does not mean that in 5, 7, 10 years, something changes and they're not great at that moment when you need to make a lease negotiation, or at that moment when your loan's coming due if you have a loan on it. So we really like to diversify across those types of assets. Also, a lot of the quality triple net properties are at higher price points, like the distribution centers. Those could be anywhere from, 5, 7, 20, $100 million buildings. And if you only have an exchange at a $1 or $2 million, you're kind of stuck with the, maybe not so strategic net leases. Maybe they have a credit tenant in there, but they're not on a hard corner. They're in the middle of nowhere. They're in a tertiary market. Again, not a bad thing if you're ultra diversified, because those could be very good and stick and renew their leases. But what if they don't? And when a tenant goes dark, doesn't operate there anymore, we've all seen that driving up and down our streets, right, in Los Angeles. Um, when that happens, your building could lose temporarily until you fix the situation. You could lose, 20, 30, 40, 50+% of your equity in that deal. So it's not a situation where you want to fire sell that asset because you lose a substantial amount of money. You ultimately want to figure out a way to re-tenant it. And that's why the DSTs, while the sponsor's working through all of that, you've diversified across 5 to 10 different properties. And if one of those properties doesn't renew or goes dark or something happens to the tenant, your overall potential income still might be in a good position. You don't feel it as much. So I sorry to get sidetracked, but I think that's very important to understand. Typical minimum investment, 100 grand. This allows people to diversify. It's not 100 grand increments. If you have $79,000 as leftover funds, if you have 333,000, we can get you in, to the dollar. We like to address the debt side, as we explore DSTs and someone that wants to take on debt. The neat thing with the debt is it's at least the ones we deal with, it's non-recourse financing. So, you have risk on the equity you invest in that deal, but it's non-recourse. They can't come after your personal stuff. You're not signing on any loan documents, which is nice. The sponsor's doing that. So you're not going through this whole loan application situation. You're getting the pass-through benefit of the debt, but it's not going necessarily on your credit report. There'll be a debt component on your, Schedule E and such. So people like that too, diversifying. Debt world is difficult today. The interest rates are really high. Banks are more nervous, so maybe terms are a little more aggressive, or there's partial recourse in there if you don't have as high quality of a property. Our loan to values are typically 30 to 60%. If you're above 60%, we have some vehicles that can assist in that, because maybe you stripped a bunch of equity out. You refied a couple years ago, cashed in on your equity, but now you're at 80% and you're just trying to avoid the tax. We have some potential options for that strategy as well. So to kind of wrap this up, because I know we're getting close to the top of the hour here. The other thing that's important is, when a DST is sold in the future, can you do a 1031 exchange? Yes, and you're not necessarily stuck in DST land. If at that point you want to cash out, pay your tax, do another traditional 1031 into a, non-DST, you will. There are some DSTs, which this is a whole nother, topic, that are 721 or UPREITs. We have those. That's a different strategy where, you're going to eventually go from a DST into, a big REIT or a private REIT. And there's some pros and cons there. We definitely have availability on that strategy. But if you're in the normal DSTs, you will have the option to do a 1031 exchange. DSTs, all the potential net distributions and net appreciation after closing costs is given to the investors. It's not like a typical, in crowdfunding, and this is not saying it's bad structure, but crowdfunding, LLC, different development funds, there's usually a preferred return, meaning like investors need to make, 9%, and then anything above 9%, the manager splits it 50-50 or some sort of split. Some people call it like a waterfall. Again, not a bad thing. I've invested in that kind of thing, but because the DSTs are not considered partnerships, it all that potential goes to investors on 100% pro rata. There's no like waterfall with the manager. So a lot of people are starting to recognize, this is another off-topic thing, but a lot of people are starting to recognize that, oh, I can just do a cash investment into a DST. So if you have just fresh cash that you're allocating to investments, the DSCs are not just for 1031s. You could do a, $100,000. It's a great way to test DSTs too. You could do a $100,000 cash investment into this Class A multifamily. If it sells in 5 years, as an example, you could then take that cash investment and defer your gain. Versus if you just go $100,000 into a traditional real estate fund, when that liquidates, you're going to have a tax consequence. So you got to play that into the picture of your returns. At the end of the year on DSTs, you do not receive a K1. You'll essentially get like a substitute 1099 and a tax package, and your CPA can take that and move it into your Schedule E, just or however you're doing your general real estate. We touched on the debt DSTs, the debt free. No refinancing risk, gives you staying power, really important over the last 5 years 2 to 3 years as interest rates have shot up. People that have loans coming due, it really kills your cash flow as you refinance into the new market, or the lender just won't do it without you paying down the loan or selling the asset. So it gives you staying power. It allows you to just mitigate a lot of risk. It's not rocket science. If you don't have debt, you do have cash flow risk if you lose a tenant, but you don't have the ultimate property loss. You have a lot of flexibility. The other thing too that I like to say is, if you're debt free today and you go into a DST or a property and you take on a loan because maybe you are doing the tax strategy of getting more depreciation or something like that, you can never go back debt free. You're always going to have to replace that new purchase price. So you got to remember that, think ahead. Don't just think now. Think, yes, you might be comfortable with debt right now in this life stage over the next 5-7 years, but in 7 to 15 years from now, are you going to be comfortable? So we're going to wrap up here. Is perfect timing there, Jeff. Anybody who wants to learn more, go to www.kpi1031.com. Tons of educational stuff there and blogs. So Jeff and the AOA members, we really appreciate your time and the opportunity.
Awesome. Thank you so much, Chay, for sharing that with us. We do have some questions in the chat.
Yep.
And if you stop sharing, then we'll see your handsome face a little bit better. There we go.
There we go.
And hey, when was the last time you went swimming?
The people always ask me that. I probably with my kids for fun, but
Okay.
kind of a sport where you have to be really in shape consistently to and I don't know if I have all that time with kids and work, but
Yeah,
fun to get the stretch in every once in a while.
yeah, I bet. I can't imagine. All right, so yeah, we definitely have some questions here. We have Ken on YouTube. So the concept sounds good. How much in transaction fees are involved in investing in a DST?
Yeah, absolutely. I'm going to go high level because every DST could be potentially different. What is involved in a DST in terms of fees on the transaction side, like you mentioned, is and feel free to reach out because I can actually send you an example, like a live example in a prospectus. But when you create a DST or a sponsor creates it, they got to go out and put that together. So, one bucket of the fees are going to be, stuff that you generally would have spent if you're, getting the property. That could be legal fees, negotiating all the PSAs, paying for all those third-party reports, doing lease abstracts. On these big assets, there could be a little bit more of that cost than if you or me were just buying like a 4-unit building or 8-unit building. Just because some of these leases are like this thick, there could be all these addendums, and you actually need an attorney to review all that stuff. So they kind of build in what it took to close that asset. And again, every deal, it could take something different. That's why I was saying, obviously we could walk you through, and all of that is, disclosed in a private placement. Another set of fees, they call it a fee, is reserves. So inside of a DST structure, you're not allowed to do a capital call. So, a sponsor needs to do their best to kind of, pro forma out what the potential, deferred maintenance that pops up over the next 5 to 10 years, CapEx budget, things along those lines. Investors and most sponsors deals, those are investor owned reserves. So, if there's leftover, if it's not used, you'll get your pro rata share back. The third kind of section, that's where, ultimately full transparency, it's where us and the sponsor, make our fee through an acquisition or selling commission, similar to, like a real estate agent, but it's, built all into there. Definitely reach out, can give you a breakdown of that. With that said, I always tell investors there are all those fees involved, but what the sponsors do is they take that all into account. And so when you see a pro forma in a prospectus, whatever that return is, it's on the equity you invest. So they took that all into account. So you invest $100,000, whatever the projected return is, it's on the 100,000. You don't need to back out kind of what I explained, but we want to, full disclosure, let you know what that was going on.
Got it. All right. And then Mr. Cal State on YouTube. So you recycle the DST investments into new investments, and that's happening every 5 to 7 years, right? So and his question is, how do we avoid paying 5 to 10% commission on our total investment every 5 to 7 years?
Yeah. So if you were to move into DSTs, and like I said earlier, we have sponsors that are on, all different spectrums of fees. They're not super widespread because obviously all the different sponsors are competing with each other too to get equity. So no one's typically way off each other, but we can kind of fit your style box. With that said, yeah, if the DST sells in 7 years from now and you were to go to another DST, there's going to be another offering cost. Now, the goal would be that in that first DST, obviously no guarantees, but in that first DST, if you invest 100 grand, hopefully you're getting $100,000+, right? So you've overcome those fees, plus you made some potential appreciation, and then you're replacing that to work in a new deal, right? It's this, same concept that we all have to take into account when we even sell a normal piece of real estate, right? We add up our, I just sold a piece of property, an investment, and I think I had 3 to 5% closing costs just on that in my normal world. And then I went and bought you buy a new property, you pay another, chunk of money. So it's definitely something that we will walk you through, but you're going to get that decision, right? If you decide this isn't for me or doesn't make sense, you're not forced to stay. You can go your own direction.
Got it. And here's Michael on YouTube. If you have to carry debt in a DST, do you ever reach a point where the debt is cleared?
Generally, no, because that'd take a long time, right? You would have to have, a lot of principal pay down. A lot of loans are, on the front end of the loan, or, just like your loans have interest only. So usually no, but is there some principal pay down and then some appreciation that offsets that? Typically, yes, that can be accomplished, but we're not holding these deals for 30 years to pay off the mortgage generally.
All right. And then Ken had another question. If the existing asset sold is fully depreciated and a DST is invested, does the cost basis for depreciation reset so more depreciation can be taken?
No, so unfortunately, your basis carries forward. So and it's not just a DST rule. This is even if you buy your own new property. So if you're fully depleted and you're debt free and you move into another, property that you're fully or debt free, that's why I was saying earlier, some people will buy more property. They sell for 3, but they end up buying 5 million. So they have an extra 2 million, and we can run scenarios for you and your CPA so that you can go through that to get more depreciation.
All right. And Armando, do states claw back taxes, both gains and recap upon sale of DST?
So I can't speak to every state, and every state changes their rules all the time, but typically, yeah, a lot of states have a clawback rule. Usually that clawback is if you decide to tax out. So the rule is designed that for instance, like in California, that you don't just take your assets, move it to Texas, become a resident in Texas, and then decide to tax out there where they might have no, their capital gains are non-existent or very low compared to California. So what they're saying is if you continue to do 1031s, and this is obviously check with every state that you're in, but you continue to 1031s, you continue to defer that. The state's not tapping in necessarily. But if in 5 to 7 years you decide to tax out and the DST was in Texas, California is still owed their capital gains. That's what the clawback is in most states.
Great. Hey, Chay, thank you so much. And everybody, thank you for joining. And again, we're at 12 o'clock today. We'll have Dennis Block give it's New Year's resolutions. And really, he's going to be covering some of those things that you need to have in place going into 2025. And one of those things is going to be a written out rental criteria. I'm going to cover that next week. Hopefully, we'll get that event posted pretty soon. Anyway, thank you so much. Take care, everybody, and happy Hanukkah. Merry Christmas to everybody. Happy New Year. Take care.
Thanks, Jeff.
Thank you.